Hello everyone, this is BHAVIK CHOKSHI here and I hope your studies are going in full swing. In today's video, we would be doing a full revision for interest rate risk management of your CA final AFM along with all important questions of this chapter. So when we are looking at interest rate risk management, what is different in this chapter as compared to the foreign exchange or the derivatives chapter? So usually we enter into derivative contracts like forwards, futures, options, swaps, etc. in order to protect ourselves from a certain risk. Like when you are looking at a currency futures or a currency forward, you are worried that the exchange rate might change and hence you want to protect yourself. However, in case of an interest rate future, you are probably a borrower or a lender who wants to borrow at a future date or will have surplus funds and wants to lend or invest at a future date, but you're worried that the rates of interest will change, and as a result you need certain protection. So for that you have four products. One is interest rate futures. Futures are exchange traded. Second is interest rate forwards, that is one-to-one contracts, probably with banks. Third is option contracts, made up of caps and floors over here. And then there is something called as swaps or exchanges, which is typically done in order to kind of protect yourself from the fixed or floating rate exposure. So let us get started and dive into each one of them along with sums on each of them. So first of all, you have interest rate futures. Now futures are exchange traded. The problem in interest rate is everything else that you studied till now, equity, commodity, currency, are all assets. Interest rate is not an asset, it is an income or an expense. Now you cannot have a market quoted prices for incomes and expenses. You can have that for assets and liabilities, and hence interest rate futures are actually quoted as notional bond futures, where instead of showing interest rate prices, you will show notional bond prices. There may not be an actual bond pertaining to that, but a notional bond will be quoted as 100 minus the stated rate of interest. Like for example, if I want to borrow money, let us say in March, today let us say we are sitting in October, so you want to borrow money in March, which may be let us say 6 months away, for a period of 3 months. So what I will enter into is a 3-month March futures. March is a date when you want to take the borrowing, and 3 months is a period for which you need the borrowing. And these futures will be quoted as 100 minus the rate of interest. So let us say the rate of interest prevailing or expected to prevail in March is 6%, and as a result these futures will be quoted as 100 minus 6, and hence they will be quoted as 94. Now one might say that you want to borrow money only for 3 months. Still, when you want to quote the price, it will be quoted as 100 minus 6%. 6% is the per annum rate, that is 94. Now this is the price of a notional bond, but should you buy that bond or should you sell that bond? That depends on whether you are a borrower or a lender. So in case of an interest rate future, which is a bond future, you will ask yourself that, are you a borrower? Well, a borrower will usually sell the bonds or issue the bonds. Or are you a lender? A lender typically buys or purchases the bonds. So strategy over here on whether you want to buy or sell depends on whether you are a borrower or lender. As we see over here, a borrower will sell the bonds, whereas a lender will buy the bonds. Now which bonds? Well, typically bonds which cover your date of borrowing. That is, if you want to borrow in March, a bond which at least is covering up to March or even beyond and is closest to your borrowing date. So over here, if you have a January future, a March future and a July future, and you want to take the borrowing in March, you will take the relevant March future for the purpose of your hedging. So this is selection of maturity. Next is, how many bond futures should you take? Well, remember, futures contract have a contract size. So if you want a desired borrowing of 100 crores and the futures contract size is 10 crores, then ideally you will take 100 crores divided by 10, that is equal to 10 contracts. This is provided you want a borrowing for 3 months and the exchange is also giving you futures contract where you can do a borrowing or lending for 3 months. In which case, you will take 10 contracts. However, it might sometimes happen that you might want a borrowing for 3 months, but exchange does not have a contract which gives a borrowing only for 3 months. They have a contract which gives a borrowing for 6 months. In which case, you might have to do certain adjustments. And the adjustments over here will be, if you are taking the numerator, the desired borrowing, you will multiply that by the number of months under the desired borrowing, and in the denominator, if you are taking the futures contract size, in the denominator, you will take the number of months under the futures contract. So if that is 6 months, this will be how it should appear. So this is 100 into 3 upon 10 by 6, and hence this will be 5 contracts. So these are called as equivalent contract adjustment. So over here, you will sell, because you are a borrower, 5-6 month March futures contract for the purpose of hedging. So today you might be sitting, let us say in October, November, whatever, but you want borrowing, let us say in the month of March. Now when you reach March, if you go to the exchange and you want the borrowing, an exchange usually does not give you an actual loan or take a loan from you. An exchange will usually net settle. And hence, if you actually want to take a loan, you will have to go to the spot market and take a loan. So let us say in the month of March, actually the rate of interest in the spot market moves up to 9%. You were worried that the rate of interest will go up, and it actually went up. It went up to, let us say, 9%. And hence, if you were to take a loan, you will have to pay an interest on the actual borrowing at the rate of 100 crores into 9%, because you have actually taken the loan at 9%, into 3 by 12. The loan is for 3 months, and hence that will give you a 2.25 crores cash outflow. However, when we look at a futures contract, once you actually take the spot borrowing, you don't need the futures contract, and hence you will close the position under the futures contract. Now, how do you cover or close or square off the position? You take the offsetting position. That is, if you have originally entered into a contract to sell the bonds, let us say 5 bonds, 10 bonds, whatever it is, at the rate 94, you will cover it, cancel it, close it by entering into a contract to buy these bonds. So you will buy these bonds at what rate? Well, at the prevailing futures rate. So let us say, for simplicity, let us say the rate in the futures market is 100 minus 9, that is equal to 91. So I have sold at 94. Now I don't need the futures contract. I will close it by buying it, for example, at 91. And hence, I can find the gain or loss. How do you find the gain or loss? Sir, selling price minus cost price. So if your selling price was 94 minus a cost price, this is 91, and hence that is a gain of 3. But remember, this is not 3 rupees. This is a gain of 3%, and that is percentage per annum. So this is a gain of 3% per annum on a futures contract borrowing of 10 crores. But the futures contract you are borrowing for 6 months. Remember, your desired borrowing may be for 3 months, but futures contract you are borrowing for 6 months. So if you want to calculate the gain or loss, and we'll do practice on this, when you hear this, it might sound to be a little intimidating. However, if you do it with pen and paper on sums, it is fairly easy adjustment to apply. So you will say that, okay, so this is, for example, 94 minus 91, that is in percentage, into 6 by 12, into a futures contract size of 10 crores, and you have entered into 5 such contracts. So if I do this working, probably I will get around 0.75 positive. Now I am paying 2.25 crores on my spot borrowing, 100 crores into 9%, the rate in the spot borrowing, into 3 by 12, and I'm getting a net settlement gain of 0.75 crores on my futures contract, and hence my net interest outflow is 2.25 minus 0.75, that is a net 1.5 crores of net cash outflow. So if you want to find the effective cost of borrowing, you will say that you are ultimately paying 1.5 crores. Well, as such you are paying 2.5, but you are getting 0.75, and hence you are paying 1.5 crores on a borrowing of 100 crores for a period of 3 months. And hence, if you want to find a per annum rate, so 1.5 is for 3 months, and for 12 months how much? So you will find the effective interest as 1.5 upon 100 into percentage at 100 into 12 by 3, and this will give you 6% per annum. Now this is your effective rate if the question asks you. So this is regarding interest rate futures. We will do a sum on this of futures and forwards together. So we will also jump on now to the second part where you are looking at forwards. Forwards in the context of currencies or in the context of interest rate over here are over the counter contracts, that is one-to-one contract with the bank. And because it is a one-to-one contract, you don't need a quoted market price. So you don't need to make an interest rate forward into a notional bond forward. And as a result, what you are quoting is in the form of interest rates only. In futures, you had a problem because you had to show the quoted price. Here, you don't have to show any quoted price, and hence you can very well show this in the form of interest rates. So over here, there is something like this. There is something called as FRA. And how are FRAs denominated? Let us say you are sitting in the month of October and you want to take a borrowing after 5 months for a period of 3 months. I'll again repeat, you're sitting in the month of October. So maybe after 5 months, let's say February or March, you want to take a borrowing which will run for 3 months. If you look at futures, futures will call this as 3-month March futures you would want to take. However, in case of a FRA, this is quoted as a 5 by 8 FRA. Now, how do you understand what is meant by 5 by 8? 5 is a number of months from today's date till the date you want to take the borrowing. And 8 is the total tenure. So 8 minus 5, that is 3, will give you the tenure of your borrowing. So 5 by 8 FRA would technically mean that I need a hedge for a borrowing that I intend to take, let us say after 5 months, for a period of 3 months. So I will enter into a 5 by 8 FRA. But when I say I enter into, again, I will have to figure out the strategy. The strategy over here, sir, you have taught us that a lender will buy the bonds and a borrower will sell the bonds. Perfect. That works if my contract is on the bonds. However, in case of FRA, my contract is not on the bonds. My contract is on the interest rate. So over here, I will not see what I'm going to do with the bond because the contract is not on the bond. Interest rate futures is taking bond as a base. FRA or forwards is not taking bonds as a base. So in such a case, what will you look at? Sir, in this case, what we will look at is, what am I doing? As a borrower, I will pay for the interest. I will pay cash for the interest. You usually pay cash for something that you buy, and as a result, in case of a borrower, we say borrower usually buys in case of a FRA. However, a lender gets interest. He gets a cash inflow. And usually you get cash inflow when you sell something. And hence, we consider that the lender is selling the FRA. If I try to compare it, and what creates confusion is the strategy is exactly opposite for an interest rate future versus an interest rate FRA. When you look at an interest rate future, the underlying is a bond and the borrower sells the bond. However, in case of a FRA, the underlying is the interest itself and the borrower pays for the interest, so he is buying the FRA. The opposite applies for lender, which in case of futures, I buy the bonds in case of futures. However, when I come to FRA, I get interest, I get cash for interest, I get cash for something that I sell. So I hope you understand that the strategy is exactly opposite. You are intending to achieve the same goals, but because the underlying product is different, the strategy becomes opposite. Now, when we are looking at FRA, well, that is, we discussed about the strategy and also FRA terminology, which is a slightly important and a slightly different terminology to understand. Now, in the context of institute questions, time value adjustment. Now, when you look at FRA, a pure FRA question where there is just FRA, institute usually does a time value adjustment. Why? Well, because FRA is on interest and interest accrues over the period of time. So if I am sitting in October, I want to borrow in March, the interest will be paid not in March, it will be paid 3 months later. And hence, if I want to settle the contract in March itself, then interest is not due in March, interest is due 3 months later, and hence we will do time value adjustment. In a pure FRA question, institute does the time value adjustment in March. March is called as a fixing date, in which you will try to say that, okay, if I have to pay interest of, for example, net, I entered into a contract at 6%, I decided to borrow. So I decided to buy at the rate of 6%. Now the rate becomes 9%. So in order to offset, I will take the opposite position. So I will sell at 9. 9 minus 6, that is equal to 3%. 3% into, for example, 100 crores. That is per annum into 3 by 12. And as a result, this will be giving you, for example, 0.75 crores. But this 0.75 crores is due 3 months later. And hence, if you want to settle it, you don't want to wait for 3 months. If you want to settle it on the fixing date itself, you will take the present value. And for taking the present value, the spot rate in March will be taken as a base. However, in sums where you have only futures, institute never does the time value adjustment on the futures, because futures net settle on a particular date. So if I'm closing the contract in September or in let us say March, the mark to market settlement will happen in March itself, and as a result there will be no separate time value adjustment that institute does for futures. Now the problem arises in questions where there is futures as well as FRA. What should you do? Remember, I'm not saying that what should ideally be done. I'm just focusing on what institute has done, because there's a lot of inconsistency when we come to the time value adjustment in case of futures and FRAs. So wherever sums involve futures and FRAs being asked in the same question, institute does not do any time value adjustment on forwards. It does not even do any time value adjustment on futures, like the sum that we will do in some time. They will not do the time value adjustment, and hence to maintain consistency, we will also not do any separate time value adjustment in case the question asks you to show the impact of both FRAs and futures. If it asks you only futures, again no time value adjustment. If it is only FRA, then you will do time value adjustment to keep peace with the institute, and we have tried to summarize that over here as well. Okay, so what we will try to do is we will try to address a question on this. So this is question number 1. It is also there in your study material if you don't have this handy. Otherwise, this is question 5 in our books. So let us review this. Over here, Electrospace is a consumer electronics wholesaler. The business of the firm is highly seasonal in nature. In 6 months of the year, they have huge cash deposits and hence surplus money, especially near Christmas. And for the other 6 months, there's a cash crunch, in which case you will need to borrow, leading to borrowing of money to cover up its exposures. It is expected that the firm shall borrow 50 million euros for the entire period of slack season, which is about to start in 3 months. So slack season runs for 6 months and the slack season is about to start after 3 months. Okay, so ideally we would need to borrow money after 3 months for a period of 6 months. Okay, the bank has given you the following quotations: spot rate, a 3/6 FRA and a 3/9 FRA. Actually, you are given 5.5 and 5.75. Usually the lower rate is the deposit rate and the higher rate is the borrowing rate. A 3-month 50,000 euro futures contract maturing in a period of 3 months is quoted at 94.15. That is 5.85. Even if that 5.85 was not given, we would have said 100 minus 5.85 will actually give you 94.15. Okay, you are required how a FRA will be useful if the actual interest after 3 months is 4.5 or 6.5. So you have to answer for FRA. And second, how 3 months future contract will be useful if the company's if the interest rate turns out as above. So the question is asking you to solve for FRA as well as for futures. So if I look at this question, if I first start with the futures, I will ask myself that what am I at the end of the day? Sir, I am a borrower. And if I'm a borrower and if I'm looking at futures, for futures the underlying is the bond. And hence if I look at the strategy, I'm doing this in rough. Your main solution is printed and given. Your strategy would be, as a borrower, I would prefer to sell the bond futures. Acha, which bond futures? If I select the maturity, there's only one maturity. This is the 3-month futures, which is available at the rate of 94.15. So this is like my selling price. And the number of contracts. If you want, pause the video and try to find the number of contracts. There's a possibility you might make a mistake. So over here, that is 50 million. 50 million is like 5 crores. 5 crores divided by 50,000. Acha, but this 50 million you want to borrow for 6 months. However, the futures contract, if you go to see, is only for 3 months. And as a result, if I look at the equivalent borrowing, this is 50 million or 5 crores divided by 50,000 into, for example, 6 divided by 3. And hence this comes to 2,000 such contracts. So basically, if I were to summarize, I will say that I'm going to sell 2,000 3-month futures. 3-month futures at the rate 94.15, which is like my selling price. Now after 3 months, that is on the settlement date, when you actually go to borrow, what will happen? Well, exchange is not going to give you anything, and hence we consider net settlement. And under net settlement, let us say the rate is 4.5%, or in the second case the rate is, I think, 6.5% or something. Let me just verify this. So the rate is either 4.5 or 6.5, but when I look at bond prices, that is 100 minus 4.5, that effectively comes to 95.5, or 100 minus 6.5, that effectively comes to 93.5. So over here, when I look at interest on the spot borrowing, on my spot borrowing, the interest would be, I will need $50 million, which in my spot borrowing I will borrow at 4.5%, but I will need money for 6 months. Irrespective of how many months the futures contract is available, I will need money for 6 months. So that is 50 million into 4.5% into 6 by 12. So over here, if I were to do this, this is euro 1.125 million. Achha, this is like a cash outflow. Now if I were to find a gain or loss on the futures contract, so how will you find a gain or loss on futures? We will say selling price minus the cost price. You have originally sold at 94.15. This is your selling price. You are now buying at 95.5. So this is like your cost price. This is in percentage. but this is percentage per annum. Remember, the futures contract is 3 months contract. You might want a borrowing for 6 months, but the futures contract is 3 months. So into 3 by 12 into 50,000 per contract into 2,000 such contracts. Now this will give you the answer in full values. If you want it in million, you will divide this by, let us say, 10 lakhs to get your answer in million. So over here, this is what, 94.15 minus 95.5 in percentage into, let us say, so this is what, I can just skip the calculation and just focus on the essence. So this is what, 0.3375 million. So over here, let us say this is 0.3375 million. A similar calculation. So this is negative. Selling price minus cost price is negative. So that is an extra cost. And hence your effective interest, if I go to see, will be the total of these two. So if I were to again take the total, that is 1.4625. Now if I look at the rate being 6.5%, my actual borrowing cost will be 50 million into 6.5% into 6 by 12. So this will be my actual borrowing. But now when I look at the gain or loss on futures contract, I had originally sold at 94.15. Now I am buying at 93.5. And hence that's again into 3 by 12 into 50,000 into 2,000. So that will give me a positive answer to the tune of 0.1625. And hence eventually there would be the same cost. Sir, but why is it says? Well, that is exactly what hedging does. Your cost remains the same irrespective. So that is 1.4625. Your cost remains the same under a futures contract. Now how will things change under a FRA? In case of a FRA, you are still a borrower, and a borrower pays for interest, and when they pay for interest, we say we buy the FRA. At what rate will we buy? Well, we have to select the appropriate FRA. You need money after 3 months for a period of 6 months. Which FRA will you select? So we will select the 3 by 9 FRA. A very common mistake over here, would a student go to 3 by 6? We will have to take the 3 by 9 FRA. That is, you need money after 3 months for a period of 6 months. So that will be a 3 by 9 FRA. But are you a borrower or a lender? Sir, we are a borrower, and hence the relevant rate is 5.94%. So the relevant rate is 5.94% over here under the FRA. Now assuming FRA is also net settled. If the FRA is gross settled, so it is the easiest, in which case you will directly take 50 million euro into 5.94% into 6 by 12. But if the FRA is also net settled, then you will have to go to the spot market. Under the spot market, again you will have to borrow, and on your borrowing your interest is going to be the same 1.125, and your interest will be the same 1.625. If you go to see, it will be exactly the same even under FRA. This is assuming a net settlement of FRA. This is on actual spot borrowing. But now if I were to settle the FRA, this is a question which is FRA and futures both, and hence we will not do a separate time value adjustment in line with the institute solution. So we will say that at what rate have we purchased the FRA? Well, we have purchased the FRA at 4.5, we have purchased at 5.94, and now if you want to offset it, you will have to sell it. You will sell it at what rate? Sir, 4.5. So selling price minus cost price, 4.5 minus 5.94 in percentage into 50 million into 6 by 12. Sir, but conceptually, why is this a loss? Well, because you have entered into a forward contract to borrow at 5.94. The rate today, if you go to see, is only 4.5. Had you not entered into this contract, you would have borrowed at 4.5. And as a result, this will result in a loss. And that loss, we will record it in the net working. So this will be 0.36. If you want, pause the video and try to find the net settlement gain in case of 6.5% rate. Ask yourself, what did I do originally? Sir, I originally decided to buy because I was a borrower. I need to pay for interest. In FRA, I will buy. I bought at 5.94. Now the rate became 6.5. So to close the position, I will sell at 6.5. So 6.5 minus 5.94. That's a positive answer. So again, in percentage into 50 into 6 by 12, and that should give you a positive answer, which will come to 1.485. Now, if you want to find the effective interest in either cases, you will take the interest, that is 1.485, divided by the borrowing. For example, 50 million euros into 100. Now, that is 1.485 for a 6-month borrowing. So, for 12 months, it will be how much? Into 12 by 6. And that will give you your effective interest rate. Let us say at 5.94 or let us say at 5.85. So, we are just trying to quickly scan through the question so that you have a reasonably good understanding if it comes. Okay, next, before you go to, let us say, concepts of caps and floors, you have a particular concept which is also tested in valuation of securities of forward rates. Now, what do you mean by forward rates? Forward rates essentially mean the rates which are expected to prevail in the year ahead. Like for example, if I were to take a 1-year loan or put a 1-year fixed deposit, that is at 10%. But if I go to the same bank and ask for a 2-year deposit, that is, let us say, at 12%. Now that does not mean that is 12% for the second year. It is 12% over the 2 years. That is, in the first year also 12%, second year also 12%. So if I want to find the rate which is expected to prevail in the second year, which I can call as, theoretically, this is a 12 by 24 FRA. Sir, what did you say? 12 by 24 FRA. That is the rate expected to prevail after 12 months for a period of 12 months. If I want to find that, then I will say, using arbitrage principles, if I have 1 rupee starting and if I deposit it for 2 years at the rate of 12%, at the end of 2 years, I will be sitting with 1.2544. Ideally, I should have exactly equal amount if I invest in a 1-year fixed deposit at 10% and also roll it over, deposit it further for the second year at the rate prevailing for the second year if the bank is quoting that FRA. So this is R2. So this is 1.1 into 1 plus R2. So if I solve this further, I will ultimately come to an R2 of around 14.04% per annum. What does it mean? Well, this means that in general, I'm expecting the rate to be 12% for the first year and 14.04% for the second year. Sir, but the rate was 12%. 12% was the average rate for both the years. If I just want to find the rate for the second year, that is 14.04%. And this is a base that you can use for testing for arbitrage. Like for example, if theoretically the rate should be 14.04%, however, actually the bank is giving you FRA, which is a 12 by 24 FRA. The bank is giving you this FRA, for example, at 13%. Or the bank is giving you this FRA at 15%, there is an arbitrage opportunity. How? Well, I can say that, well, given a choice, if the rate, for example, under the FRA is 13%, I can borrow money at 10% for 1 year. Again, that 1.1 I can borrow for another 1 year at 13%. What will I do with the money that I've borrowed? Well, I deposit it at the rate of 12% for a period of 2 years and I will get a higher cash inflow. Or if the rate was 15%, I would say that, well, it is cheaper to borrow at the rate of 12%. So I can borrow at the rate of 12% because my theoretical FRA is 14.04. Actually, it is available at 15. Then ideally, I would love to deposit at 15, not borrow at 15. So I will deposit in the second year at 15, I will also deposit in the first year at 10%. So if I do that, actually I will be sitting at 1.1 into 1.15. So I will be sitting at, for example, 1.265 after 2 years. But if I'm an arbitrager, I don't have money. So I can borrow at the rate of 12% for 2 years, in which case my cash outflow after 2 years on the borrowing will be around 1.2544. And as a result, I will still make money because my cash inflow on depositing it for 1 year and then rolling it over for another 1 year is greater than the cash outflow. So if you want, you can practice sums on this as well. There is a sum or two in the study material and our books on this concept as well. This is on the forward rates and the arbitrage using the forward rates. Next, we have interest rate options. Now, options typically you used to call as call options, put options, etc. However, in the context of interest rates, you call this as caps and floors. What do you mean by cap? A cap protects a floating rate borrower from a possible rise in the interest rate. So if I've taken a 3-year floating rate borrowing, I am worried that over the 3 years, what if the rate goes up, shoots up? In which case, I take a cap. When I take the cap, it means if the cap is taken at 10% and if the floating rate, let's say something like LIBOR, goes beyond 10%, then I will get a net payoff under the cap. So usually when does cap give me a payoff? If I'm a cap holder, it will give me a payoff if the actual floating rate, that is a LIBOR, is greater than the cap exercise price. So if the LIBOR becomes 12% and the cap exercise price is 10%, then 12% minus 10%, that is for 2% into whatever is the principal into the number of months divided by 12 will be the payoff that I will get. However, if the LIBOR is only, for example, 8 or 9% and the cap exercise price is 10%, then the cap on that particular date will not have any separate payoff, because if the rate goes beyond the exercise price, only then will the cap be exercised. So cap protects a borrower from a possible increase in the interest rate. Then what is a floor? A floor is something which protects a floating rate lender. As a lender, I'm worried that I've invested in a floating rate bond, but what if the rates of interest fall? They become 2%, 3%. I need to earn at least 5%. So I buy a floor at the rate 5%, which means if the rate falls below 5, in which case the floor will be exercised. So if the rate becomes 2%, then I will get a payoff under the floor at 5% minus 2% into the principal into the number of months covered divided by 12. So when will a floor be exercised? It will be exercised when the floating rate is less than the exercise price. So basically the payoff will be the exercise price minus the floating rate into the principal into the number of months divided by 12. Now, floor typically protects a lender, a cap typically protects a borrower. Now, what do you guys think? When I enter into a cap or a floor, there are two parties. One is a cap holder, one is a cap writer. One is a floor holder, one is a floor writer. Do you think someone will give me the cap free of cost? No. It's an option product for which we will have to pay what you call as a premium. And when we are paying, let us say, a premium, that pinches us. So that premium has to be considered. Again, for a floor, if I'm a lender, if I want to buy a floor, I will have to pay a premium. So that premium might pinch me, and hence a strategy to reduce my premium outgo is maybe entering into a collar. A collar would mean for a borrower, I will buy the cap because I'm worried that the rate of interest will go up. But at the same time, I'm not really worried. I'm pretty sure the rate of interest will not go down, and hence I might sell the floor. So as a borrower, I might buy the cap, sell the floor. That is called as a collar strategy. Typically, this is done to reduce the premium cost. Or as a lender, I might enter into a contract to buy the floor because I'm worried that the rates might go down, but I don't think they will go up, in which case I can sell the cap and recover some of my premium cost. This is called as a collar. Now, when we look at premium, the problem is premium has to be paid upfront, whereas the payoff under the cap or the floor is going to happen in the future, and hence they are not comparable at the same points of time. So if you want to make it comparable, you will either have to take the payoffs to the present value or you take the premiums to the future value. Institute over here usually amortizes or converts the premium into an annuity. So they say that, okay, if I have to pay 100 rupee premium upfront for a 3-year cap, 100 rupees today is equivalent to how much? An annuity of how much over a 3-year period. So if I want to find the effective cost under the cap, I will try to find the payoff that I generate from the cap under each of the years and then compare it with the equated annualized or 6 monthly premium. How do I do that? Well, I will take the premium divided by the PVAF. So I will say 100. For example, let us say the discount rate is 10%. 100 of premium to be paid today is equivalent to 100 divided by PVAF at the rate of 10% for a period of 3 years. So this is, let us say, 2.48 for simplicity. In which case, this will be 100 divided by 2.48, which is approximately 40.32. Now, what does this number indicate? It indicates that I will be indifferent paying 100 rupees today or paying 40.32 at the end of the first year, another 40.32 at the end of the second year, another 40.32 at the end of the third year. This formula is based on the IRR principle, where you take loan divided by PVF to convert. So IRR says PV of cash outflow equals to the PV of cash inflow. So 100 today equals X into the PVAF at the rate of 10% for 3 years. And as a result, this will give me an annuity. Sir, when will I do this equalized premium adjustment? Typically, when there is a premium, there will be a sum in your study material, which even came in the exam, where the premium becomes 0. Why? Because it is a zero cost collar, in which case there is no premium, there is no need to do such adjustment. Or the rate of interest, the fixed rate of interest on today's date has to be given. If the fixed rate of interest is not given, again you cannot possibly do that adjustment. So time value adjustment for finding the annualized premium should ideally be done in the other cases. So if I try to do a particular problem on this, the second question, again this is a slightly interesting one. If you read this question, XYZ borrows 15 million 6-month LIBOR plus 10%. Remember, the rate of interest unless otherwise given is always a percentage per annum number. Sir, but it is given as 6-month LIBOR. Acha, if you go to open a bank fixed deposit, you will see rates given at different tenures. 6 months, 1 year, 2 years, 3 years, all those rates are still percentage per annum rates. And as a result, over here, this rate is LIBOR, 6-month LIBOR plus 10%. Okay, for a period of 24 months. Okay, the company anticipates a rise in the LIBOR. You are borrowing and you are anticipating the rise in LIBOR. So you are worried that LIBOR will increase. And if you are borrowing floating rate, that will make your borrowing costly. And hence proposes to buy a cap option. Perfect. From its bankers at a strike rate of 8%. Achha, this 8% has to be compared with whom? With only the LIBOR, not LIBOR plus 10%. Unless the question tells you that the reference rate is LIBOR plus 10%, it is always. For comparing the cap, a banker might not even know at what rate you have borrowed. So banker says that ideally I will compare the LIBOR with the strike price or exercise price to decide. So I will compare what the 6-month LIBOR is with, let us say, the strike price to decide the cap payoff. The lump sum premium is 1% of the entire for the entire reset periods, and the fixed rate of interest is 7%. Achha, this fixed rate is given as 7%, and hence you can try to find the equalized annual or 6-monthly premium as well. The actual position of the LIBOR during the reset periods are as under. So you have been given 3 different LIBORs for 3 different reset periods. Ideally, you should have also given the reset period for the 4th period, because ideally it's a 24-month instrument, and hence 24 months will have 4 different 6-monthly periods. So ideally you should have taken or you should have been given for 4 periods, but if it is given for 3, we will consider 3. Maybe for data for the 4th period is not available, or one of the periods is already done. We are not very sure. You are required to show how the interest rate risk is hedged using a cap option. For your calculation, work up for 4 decimals and round off to the nearest pound. Everything should form a part of your answer. That's fine. So over here, if I go to see when will the cap be exercised. So if I look at the cap, for cap, what is the strike price? Exercise price is 8%. So this cap will be exercised whenever the LIBOR is greater than 8%. Is it greater than 8% over here? Yes. Greater than 80% over here? Yes. Greater than 80% over here? Yes. So coincidentally it is exercised at all the 3 periods. Is it necessary it has to be exercised at all the 3 periods? No. There is a possibility that in one of the periods, instead of 10%, this was given as 7%, in which case there would be no exercise. Achha, in this case that is not the case, and the cap will be exercised. So what is the cap payoff? For me, my cash outflow under the cap would be the premium, but the cash inflow will be what? 9% minus 8% into the 15 million borrowing. However, the reset period is a 6-monthly period, and hence into 6 by 12. So this is what? 15 million into 1% and divided by 2. So this is, I think if I take the full numbers, this will be, if I take this into millions, this is what? 75,000 positive. So this is positive cash outflow, but after 6 months. Similarly, in the second case, this is 9.5% minus again 8% into 15 million again into 6 by 12. So this would be probably 1,12,500, and the last case would be 10% minus 8%, that is 2% into 15 million. Sir, why are you taking into 6 by 12? Because there are 4 reset periods of 6 months each, and hence this is 1,50,000. So due to the cap, over the time period, I will say 75 plus 112,500 plus 1,50,000, and hence 337,500 is what I am gaining. However, when I look at this 337,500, these are arising at different points of time. Does that come against a cost? Answer is yes. Sir, what is the cost? Well, 15 million into 1%, that will come to probably 15 million, that is 1 crore 50 into 1%, that comes to what? 1,50,000 pounds. But that is 1,50,000 pounds to be paid today. Now 1,50,000 pounds to be paid initially is not equivalent to 1,50,000 or a particular amount paid over, let us say, 4 reset periods. And as a result, we will try to convert this into an annuity where we would say, well, 1,50,000 divided by the PVAF, but the PVAF would be at 7%, but 7% is per annum. Now 7% for 12 months is equivalent to 3.5% for 6 months. Acha, so this is a 24-month borrowing. So 24 months is like 2 years. However, I am not taking 7% as a base, I am taking 3.5% as a base because the cap payoff is happening every 6 months. So 3.5% over 6 months, and there are 4 6 monthly half yearly periods. So this is divided by 4. So this is 1 divided by 1.035, 1, 2, 3, and this will be 2 point, for example. I think it has to be taken for 4 periods. 1 divided by 1.035, 1, 2, 3, 4. And this is 3.6731, let us say. And as a result, 1,50,000 upon 3.6731 will come to around 40,837. So I am indifferent paying 1,50,000 today or paying 40,837 over a 6 monthly period over 4 such 6 months. And hence, if I want to calculate the effective cost, I will say yes, I've got 75,000 benefit, but that comes against a 40,837 cost. I've got a 1,12,500 benefit, but it again comes against a 40,837 cost. And hence, this is what, 75 minus this effective payoff, 1,12,000 minus this effective payoff, 1,50,000 minus this effective payoff. So I'm getting 337,500 gross, considering premium and the corresponding time value adjustment over at least these 3 reset periods. That is around 2,14,989. So this is considering question number 2, which is also there in your study material. You can refer that. Sometimes instead of giving you interest rate options, they also give you interest rate guarantee, but the broad essence of an interest rate guarantee is the same as an interest rate option, like a cap. So the writer gives you kind of a guarantee that if you want, you can borrow at 5%. Sir, what if the rate goes at 6 or 7 or 8%? You can still borrow at 5. What if the rate goes lower, maybe 2 or 3? Well, then if you want, you can borrow at 2 and 3%. So this is like a cap option, where if the rate goes beyond 5, then you have the right to borrow at 5, but if the rate is below 5, then you can borrow at the actual rate. So the mechanics over here are broadly similar to options. So this is interest rate options, can be caps, floors, can also be interest rate guarantee. Then there is the last part, which is interest rate swaps. Now swaps mean exchanges. Now why will I enter into an interest rate swap? And what is the function of the interest rate swap? Primarily, the function of interest rate swap is to reduce my interest rate risk or to reduce my interest cost. Like, for example, if I borrowed floating rate, however, I want a fixed rate exposure. So what I can do is, I say that I have to pay floating rate to the bank. Then I will enter into a swap whereby someone pays me, that is, I receive the floating rate and I will pay fixed. So I may enter into a pay fixed, receive floating swap, for example. But sometimes it may purely be to reduce my transaction cost. Now, how will I reduce my transaction cost? Typically, there may be two entities which may be kind of the meeting for which may be arranged by a swap bank. They might say, let us say there is Mahindra in India. And there's a company like Chrysler in the US. Now, Chrysler can borrow in the US at cheaper rates. Mahindra can borrow in India at relatively cheaper rates because banks know Mahindra as well. But Mahindra wants a project in the US. Chrysler wants to set up a project in India. Now, Chrysler can take a rupee borrowing from an Indian bank. Mahindra can take a dollar borrowing from the US bank. However, there is a possibility that US banks don't know Mahindra as well, and hence they might charge a higher rate of interest. And there's a possibility that Indian banks don't know Chrysler as well, and as a result, they might charge a higher rate of interest relatively. So instead of Mahindra borrowing in the US and Chrysler borrowing in India, there may be a possibility where we might say that, well, you know what, Chrysler can borrow in the US at a cheaper rate, Mahindra can borrow in India at a relatively cheaper rate, and then they can swap their borrowings. That ways, they can reduce their transaction cost. So usually, how do you figure out whether the swap is economical or not? You will compare the cost that you will have to pay if both the entities take the desired borrowing, and compare it with the cost that you will ultimately have to pay if both the entities were to kind of enter into a swap. So in that case, you might enter into a swap and then share the swap gains. We will do this along with numbers so it is understood best, otherwise it creates a lot of confusion. So over here in interest rate swaps, these are generally undertaken in order to get the desired fixed or floating rate borrowings, and in the process reduce the borrowing cost. Acha, how will you figure out whether the swap is economical or not? Well, you will see if there is any overall savings. Overall savings is what is the total cost of borrowing under the original desired strategy less under the swap strategy. If there is an actual saving, then swap is economical. How will the savings be shared? Well, if nothing is given, the savings will be shared equally between the two parties. Maybe in certain questions, apart from the two parties, there will be a swap bank as well who might take the commission. Let us say the savings are 1% and the swap bank is agreeing to take an intermediary like broker is agreeing to take a 0.25% commission, in which case we will say that the overall savings are 1%, out of which 0.25% is the commission, so the remaining savings are 0.75%. If nothing is given, they will be shared equally. There is 0.375% savings for the first party, 0.375% savings for the second party. So over here, you will be sharing them equally unless another rate is given. So this will help you to find the ultimate cost of borrowing. We will say that if I enter into the swap, if I could have directly borrowed at 10%, under the swap my borrowing cost should be 10% minus 0.375, that is 9.625%, and accordingly design the swap. Now most of the swap questions are direct, where they have designed and given you the swap. But if you look at the November 20 exam question or even the May 23 exam question, you are responsible in that case to design the swap. Now if you have to design the swap, what will you do? You will first find the overall savings, and we will do it along with the sum so that it is understood, otherwise it is very difficult to comprehend. You will try to find the desired cost under the desired strategy minus swap, get the savings, allocate the savings between the parties in the agreed ratio, find the ultimate cost of borrowing. Once you find the ultimate cost of borrowing, then you design the swap, assuming that a person is paying the floating rate and the person who pays the fixed rate is X, and you will solve like we will do in one of the problems that we will do now. You try to find the net cost of financing, and we have discussed the steps to design a swap over here. Now this is best understood with a numerical which is based on the November 20 exam question, similar to the May 23 exam question as well. So let us review this once. IB, an Indian firm, has a subsidiary in Japan, and Zaki, a Japanese firm, has a subsidiary in India, and face the following interest rates. So they have been given, IB and Zaki interest rates have been given, INR floating, JPY fixed, whatever it is. Zaki wishes to borrow rupee loan at floating rate. So for Zaki, the desired, if I look at the desired, what Zaki desires is it wants to borrow rupee loan at floating. Now Zaki can borrow rupee loan at floating at BPLR plus 2.5%. So for Zaki, this is BPLR plus 2.5%, and IB wishes to borrow JPY loan at a fixed rate. So for IB, the relevant rate, the desired rate is JPY fixed. So for IB, the rate is, for example, 2%. So if I look at the total cost, combined borrowing cost for both the parties, this will be BPLR. BPLR is, I think, base prime lending rate plus 4.5% approximately. Acha, the amount of loan required by the firms is the same, and the current on the current exchange rate. A financial institution may arrange a swap. Swap is an exchange. So Zaki wants to borrow floating, however Zaki will end up borrowing fixed. So under the swap, what will happen? Here Zaki wants to borrow floating, however it will end up borrowing fixed. The other side, IB wants to borrow fixed, well it will stick with floating. So this is BPLR plus 0.5%. Now in such a case, if I total up, my combined cost of borrowing is BPLR plus 2.75%, which means if the amount needed by both the parties is the same, is there a savings that we are talking about Well, the answer is yes. If I enter into a swap, combined can be borrowed at 2.25%, 2.75% plus BPLR as opposed to BPLR plus 4.5% if they do a direct borrowing, and hence the savings would be 1.75% overall. Acha, a financial institution may arrange a swap which requires 25 basis points, that is 0.25% as commission. Gain, if any, is to be shared by both the firms equally. So what will I do over here? Out of the 1.75%, I will say that around 0.25% will be eaten up by the swap bank, who is the intermediary, and the remaining, that is 1.5%, will be shared by IB and Zaki. In what ratio? Well, IB will share half of it, that is 0.75%. Zaki will share the other half of it, that is 0.75%. So which means if I enter into a swap, my ultimate cost of borrowing should be lower. If I had borrowed directly, IB would have paid me, or IB would have paid 2% of borrowing. Now, if I enter into a swap, the ultimate cost of borrowing should ideally be for IB 2% minus 0.75%, because swap is resulting in a saving of 0.75% for IB. And for Zaki, my ultimate cost of borrowing would be BPLR if they would have borrowed directly at 2.5% minus 0.75% again. So this would be maybe BPLR plus 1.75%. So this is what I have to arrive at, and these were the steps I mentioned. Calculate the savings. For savings, find out the total cost under the desired borrowing, that is BPLR plus 4.5, under swap, that is BPLR plus 2.75. Find the savings, allocate the savings in the agreed ratio, and then find the ultimate cost. Now you have to design a swap. You are required to find out whether a swap can be arranged which can be beneficial to both firms, and what is the rate of interest the firms will ultimately end up paying. So if you have to design a swap, keeping this into consideration, how will the swap actually appear like? Well, Zaki and IB wanted to borrow fixed, but IB ends up borrowing floating. So we will try to design the swap in such a way that IB ultimately gets its desired cost at 1.25 and Zaki ultimately gets its desired cost at BPLR plus 1.75, so it is cheaper. So over here, if I look at IB and Zaki, and let us say they have agreed to the swap. Well, if they have agreed to the swap, then IB will have to borrow, as you see over here, at BPLR plus 0.5%. So IB will borrow, and the cost that IB will have to pay is BPLR plus 0.5%. But IB does not want to pay floating, it wants to pay fixed, and hence it will seek compensation from Zaki, where Zaki will pay the BPLR. So IB is not worried. If the BPLR increases, Zaki is going to pay the BPLR. If BPLR falls, in any case Zaki is going to pay the BPLR. So over here, this is a swap bank in the middle. Let us say the adjustment for commission, we are assuming that will be done from the fixed rate. So for IB, I'm going to pay BPLR, and I'm also going to receive the BPLR, and against that I'm going to pay the fixed rate. How much am I paying? Well, let us say I pay X, out of which the swap bank will retain 0.25%. Let us say you can even do other permutations and combinations, and hence the swap bank will net pay X minus 0.25% to Zaki. So, and Zaki is going to borrow at the fixed rate, which is, I think in this question, 2.25%. So if I were to find X, so that my swap gets designed, my X would be, well, for IB, my ultimate cost of borrowing is BPLR plus 0.5. This is the first part, plus X, I have to pay X, minus BPLR. Sir, why minus BPLR? Because this is a cash inflow. I'm receiving BPLR from Zaki. So this BPLR and this BPLR gets cancelled. But ultimately, I have to ensure that if the swap is beneficial and as per the terms agreed, instead of IB borrowing at 2, the swap should result in IB borrowing at 1.25. and therefore this answer is 1.25%. So this 1.25%, this has to be using that ultimate cost of financing over here. Using the 1.25% over here, you will say that this is 1.25% equals x plus 0.5%, and therefore you will take 0.5 on the other side. Therefore x will equal, I think, 0.75%. So basically we are saying that IB will pay 0.75%, but if IB pays 0.75%, will Zaki receive 0.75%? No. After considering the commission, Zaki will receive only 0.5%. So is my answer correctly devised? Well, let us see that what is the ultimate cost for Zaki. For Zaki, the ultimate cost would be 2.25% that I am paying plus BPLR that I am paying minus 0.5% that I am receiving. So if I do this, this comes to BPLR plus 1.75%, which was what my ultimate cost of financing should have been for Zaki. This is one possible case. You can even take some other assumption that, let us say, Zaki agrees to pay BPL plus 2%, in which case your X will proportionately get adjusted. So basically, you will design a swap whereby IB borrows at the floating rate, Zaki borrows at the fixed rate, and then IB pays a fixed a fixed 0.75%, and Zaki pays BPLR and 0.25% commission. Overall gets retained, and all of these will get kind of covered. So this is what you need to consider broadly. So I hope this is clear in terms of the theory as well. Now apart from that, in case of swaps, two other things that you should be aware of. One is something called as a generic swap, and one is something called as overnight index or OIS swap. Usually the swaps that are long term in nature, maybe 3 years, 4 years, are called as generic swap, and the generic swap settlement happens usually every 6 months. So the LIBOR or interest rate changes daily, but I don't incorporate the interest rate change on a daily basis. In fact, in a generic swap, I will incorporate the interest rate change after every 6 months. So I will take, let us say, reset periods at 1st April, 1st October, etc. In which case I will say that for every period, the LIBOR will be the LIBOR prevailing on 1st April. For the next 6 months, the LIBOR will be prevailing, let us say, on 1st October, and so on. So in that, you will take maybe 360 days, 365 days, actual number of days. We have written a note over here just to keep it consistent with the institute. Institute usually takes the fixed payments at 30 by 360, that is every a month has 30 days and the year has 360 days. Whereas when it looks at the floating rate, that's not very consistent, but it takes actual by 360 convention, where it takes the actual days and then 360 days for the entire year. Nevertheless, that is what the institute has done in the sum that is there. And also there is something known as overnight index swap. Overnight index swap is typically a short-term swap, where the swap period is less than, let us say, a year for sure, maybe a few days, maybe a few weeks, in which case it does not make sense taking the LIBOR today and then resetting it after 6 months. For all you know, the swap will not run for 6 months. The sum that is there in the institute study mat, the swap is only for 7 days. If the swap is for 7 days, it does not make sense resetting the LIBOR after every 6 months. So in case of an OIS or an overnight index swap, the LIBOR rate gets reset every day, rather every working day. If there is a non-working day, let us say Sunday for example, then the rate prevailing on the previous day, let us say Saturday, will be taken for 2 days while calculating the interest payment on the floating rate. Are we clear with this? Okay, so this by and large takes care of the interest rate risk management chapter. I hope this video has been helpful for you. I've tried to kind of incorporate both the sums and the concept, but again this is a chapter which requires a fair bit of understanding. Please do not leave this chapter. It might sound to be very difficult. However, the sums that come, if you are comfortable with the terminology, most of the times the sums are in a position to be directly solved. So I'll see you soon with another revision video. Till then, thank you very much. Also, if you want me to incorporate something else or make certain changes in the videos, please do write in the comment box, or if you liked the video, I will be really obliged if you press the like button, means a lot. Share and subscribe as well. Till next video, see you. Bye bye. Take care.